Tired of second-guessing your trades? The moving average might be the simple tool you're overlooking. In this video, we are breaking down 3 easy and effective ways to use the moving average indicator to spot accurate trade signals. If that sounds helpful, make sure to like the video and subscribe for more no-fluff trading content. A moving average is one of the easiest tools you can use when looking at charts. Basically, it takes the average closing price of an asset over a certain number of time periods. Why is this useful? Well, the markets can be really noisy, with prices jumping up and down all the time. The moving average helps smooth out those ups and downs so you can get a clearer picture of the overall trend. It's like looking at the big picture, instead of getting distracted by every little movement. Different moving averages can show you different things depending on the length you choose. A 200-period moving average is great for spotting the long-term trend of a market. It helps you see which way the big players are moving over a longer stretch of time. On the other hand, a 20-period moving average focuses more on the short term, showing you the recent trend and helping with quicker trade decisions. Some of the most popular moving averages people use are the 20, 50, 100, and 200 periods. These numbers aren't random. They're commonly watched by traders, so they can act as important support or resistance levels. Overall, the main goal of using a moving average is to simplify what's happening in the market and make it easier to spot the trend. But there's more to it than just that. Moving averages can be used in different ways to help us make smarter and more accurate trades. So let's jump in and look at some specific ways you can use moving averages to improve your trading. The moving average is mainly used for 3 things: spotting the trend, noticing when the trend changes, finding support and resistance levels. Since it's a trend-following indicator, its main job is to help us figure out which direction the market is going. And to do that, we've got 3 simple techniques that can make things a whole lot clearer. One of the easiest ways to spot the trend is by looking at where the price is in relation to the moving average. If the price is sitting above the moving average and keeps staying there, that usually means the market's in an uptrend. And if that's the case, it makes sense to look for buying opportunities. We want to trade with the trend, not against it. Now, if the price is hanging out below the moving average and consistently staying under it, that's a sign of a downtrend. So in that situation, we'd be looking for chances to sell. But what if the price keeps bouncing above and below the moving average, not really staying on one side for long? That usually means the market's moving sideways, or it's range-bound. When that happens, it is usually best to step back and wait. No clear trend means no real edge. And sometimes, not trading is the smartest move. Here's a super simple trick to improve your chart analysis. Try using 2 moving averages with different settings. This lets you see both the short-term and long-term picture of the market at the same time. Let me break it down for you. On this chart, we've got 2 moving averages. The yellow line is the 20-period MA. The blue line is the 200-period MA. The 20 MA is great for spotting the short-term trend, while the 200 MA helps us understand the longer-term direction. Now let's put the 200 MA aside for a second and just focus on the 20 MA. During these parts of the chart, the price is clearly staying above the 20 MA, which tells us we're in a short-term uptrend. That's usually a green light to look for buy setups. But then we also see times where the price dips below the 20 MA. That would suggest a short-term downtrend, and in those moments, we'd normally look for short or sell opportunities. Here's the thing though, when we look at those downtrends more closely, the moves weren't all that strong. There wasn't much momentum. That means the long-term trend was still up, so those short-term dips were happening within a bigger uptrend. Selling during that period would have meant going against the larger trend, and that's always risky. Let's check out another section. If we zoom in here, we can see the price moving sideways around the 20 MA for quite a while. That's a classic sign of a range-bound or sideways short-term market. But look at the 200 MA. The price is still staying above it. So while things were choppy in the short term, the bigger picture was still bullish. In a situation like this, you've got a sideways market with a long-term upward bias. In this case, you have 2 options. You can either stay out of the market and wait for a clear breakout, or you can take buy trades near the bottom of the range. But definitely avoid selling at the top. That would go directly against the long-term trend. So yeah, using two moving averages won't magically give you better trades, but it will help you stay out of the bad ones, and that alone can make a huge difference. If you're enjoying the video so far, go ahead and hit that like button and subscribe to the channel so you never miss out on more trading tips like this. When it comes to spotting a trend reversal, there are two simple techniques you can use. Like we talked about earlier, in an uptrend, the price usually stays above the moving average, and in a downtrend, it tends to stay below. That's the basic rule. So based on that, if the price drops below the moving average after being above it for a while, that could be a sign the uptrend is losing steam, and a downtrend might be starting. In other words, it could be the beginning of a bearish reversal. On the flip side, if the price moves above the moving average after spending time below it, that might be the first sign that the downtrend is over and a new uptrend is beginning, a possible bullish reversal. But here's the catch. Not every time the price crosses the moving average means something important is happening. Sometimes these crossovers are just noise, little fakeouts that don't actually lead to anything. That's where our second technique comes in. It's called the moving average crossover, and it's one of the most popular ways to use this tool. To do it, you'll need two moving averages with different time periods. Just like before, let's use the 50-period MA and the 200-period MA. Here's how it works. In a strong uptrend, the shorter MA, the 50, will be above the longer MA, the 200. In a downtrend, the opposite happens. The 50 drops below the 200. So when that crossover happens, the 50 crosses below the 200, that's often seen as a signal that the trend has flipped from up to down. It is what traders call a bearish crossover, or a signal of a potential bearish reversal. And when the 50 MA crosses back above the 200 MA, that's a bullish crossover, meaning the trend might be shifting from down to up. Now, just to be clear, we're not saying you should blindly enter trades every time this happens. Crossover signals are helpful, but they work best when combined with other tools or confirmation signals. So those are the two simple ways to spot trend reversals using moving averages: price crossing the MA and moving average crossovers. Both are easy to spot, and when used the right way, they can really improve your trading decisions. All right, now let's talk about one of the most useful ways to use the moving average, as a dynamic support and resistance level. When most people think about support and resistance, they imagine fixed price levels where the market tends to stop and reverse. But moving averages work a little differently. Instead of a single price point, they act like a moving line that shifts with the market, giving you a flexible level to watch. In an uptrend, the price tends to stay above the moving average. When the price dips back toward that line, it often finds support there, like it's getting a little boost before continuing higher. This makes the moving average a handy tool to spot potential buying opportunities during an uptrend. You'll often see the price come down to touch the moving average, then bounce right off it, confirming that the moving average is acting as a sort of safety net below the price. On the other hand, during a downtrend, the price usually stays below the moving average. When it tries to move back up and approach that line, the moving average acts as resistance, kind of like an invisible ceiling holding the price back. This gives you a chance to look for selling opportunities near that level. Again, the price tends to touch or bounce off the moving average, showing that it's respecting this dynamic resistance level. So, moving averages don't just smooth out price action, they actually give you a moving reference point that can help you spot where the price might pause, reverse, or continue in its trend. Watching how the price interacts with the moving average can really give you an edge when you're deciding where to enter or exit trades. And that's a wrap for this video. We just went over how the moving average indicator can be a powerful tool in your trading toolkit. If you enjoyed this breakdown or learned something new, go ahead and hit that like button, and don't forget to subscribe so you stay updated with all our upcoming videos. Thanks for hanging out, and I'll see you in the next one.